so much for tuning in again to KNG TV. I want to start off by saying thanks so much for listening to what we've had to say over the last few weeks. We really appreciate hearing from you all. We are new to this, but we're enjoying it so far. If you like what we have been saying, please subscribe to our channel, hit the like button, hit the bell so that you can get a notification every time we post a video. And of course, follow us on Instagram. We have things to say that we say on there all the time with respect to building wealth. Greg's thoughts on building wealth, he posts on our live feed pretty regularly. So it's just an enjoyable time.
Yeah, so today we're going to give you the numbers behind flipping a property, some of the general industry standards that we found, and I think it's going to be really exciting.
Yeah, we'll do that, and we'll talk about the numbers behind doing buy and holds. If you watched any of our previous episodes, we explained what a buy and hold was, what a flip was, and if you just go back and watch those, you will have a good understanding of what each of those are. But very quickly, a flip is when you buy a property for the purpose of quickly turning it around and selling it for profit. But a buy and hold is when you buy a property for the purpose of holding on to it and collecting rental income over time. The buy and hold strategy is the strategy that Greg and I use to go about building our wealth. But flipping is another way that other people have found very fruitful. It's just not particularly the way that we do it. Numbers. Greg's a numbers guy. He loves numbers. He's going to start us off with the flipping numbers. For each of these examples, we're going to use $200,000 as the after renovated value for each property.
All right, so with the value that we call after renovated value is what you're going to look at when you're going into your flip deal. So after renovated value just accounts for what a buyer would buy the house for in the condition that's livable in accordance with the comps in the market. So that's what your after renovated value is. And when I say purchase price, that's going to be the price in which we bought the home for, and then we'll go from there. So with our $200,000 after renovated value example, let's say we purchased the property for $100,000. All right, so at $100,000, we're at 50% of our after renovated value. So the reason why this 50% is so important is because industry standards for our area for flipping a home is getting all of your work done, buying it, rehabbing it, all done within the 65% of after renovated value range. So 65% of after renovated value of 200 puts us at $130,000. So what that says is that if you purchase the property at $100,000, you have $30,000 that you should put into the rehabilitation of this house to be at industry standards. And what does that mean? That means that if you want to be on par with a good flipper, you will only put $30,000 into this rehab. And $30,000 is not a lot for rehab. So when you think about this, this person is probably replacing some floors, might knock out a wall, but they're not doing structural work. They're not really changing where bathrooms are and things like that. Because in construction, $30,000 is not a lot of money. So
these are cosmetic changes. Carpet down, paint on the walls. You might need to upgrade some appliances, paint some cabinets. With only a $30,000 renovation budget, you might need to get in there yourself and do some of these things. But it's definitely doable. We know people have done it. We've done it. $30,000, get in, get out.
All right. And then for this example, we'll also allocate $10,000 for things that will go wrong during your rehabilitation.
Because it inevitably will. You will not account for something. You'll pull up some carpet and you'll see mold on the ground. And there's a whole moisture issue that you got to worry about. Things will happen. Allocate $10,000 for those unexpecteds.
Yeah, so $10,000 let's keep up with our percentages, is 5% of the overall after renovated value. So let's say you buy the house at $100,000. Remember, we bought the house 50% of the after renovated value. You rehabbed it with $30,000 and things went wrong and you had to put an extra $10,000 in. You're now at 70% of your after renovated value. But you have a nice house and everything's great. Now you put the house on the market.
Yeah. So the house is on the market. The house is about to sell. The house ends up selling for $200,000, which is what we expected for the after renovated value. Once that sells, you have to account for about 10% of that purchase price going towards some of the closing costs. As a seller, you're going to end up paying real estate agents for the buyer, maybe even for yourself if you had to acquire one, and then other fees like title checks and things like that that will be a part of the closing costs. It's normal to account for 10% for those fees. So after you add that 10% of 200,000 is
20,000.
Yeah, so you were all in at 140,000. You had to pay expenses for 20,000, and now your profit is
so 20,000 added on to your 140,000 that you put in puts you at 160,000, and so your take-home money is $40,000.
$40,000. That is what you've benefited from a flip. But let's remember, what kind of taxes do we have to pay on a flip?
You have to pay short-term capital gains tax.
Capital gains taxes, which right now sits at about 22%, and it could go up or down depending upon who's president. So
Absolutely.
With that in mind, those are the numbers for a flip. Quickly, the numbers for a buy and hold are as follows. We're starting off with $200,000 because that's what we project the after renovated value to be. Let's say that you are going to buy a property that has already been renovated. So everything that Greg just said he did to flip it, then I came in and I bought it. I came in and I bought it at $200,000 after renovated value. Now, to buy a property for $200,000 that you are going to rent out to someone else, that's not going to be your primary home, you're going to have to pay between 20 and 25% down. So for this example, we'll account for 25%. Let's say you have to pay $50,000 down to purchase the home. You then have a 1% rule when it comes to rent, meaning that ordinarily, depending upon what area you're in, you can charge 1% of the total purchase price for rent for that area. So
charge no less than.
Charge no less than. Greg's all about making money. You guys should be too. Don't charge less than 1% of the purchase price. Anyways, so you pay that 1%. You're charging the 1% for renters to live there. 1% of 200,000 is 2,000. So you're collecting $2,000 in rent per month off of this $200,000 purchase. Now, we might get sad at the fact that you had to pay the $50,000 down, but let's remember that money is now in equity. So it's not gone, it's still in the house. If you decided to sell the house next year, you'll get most of that $50,000 back at the point that you sell, but you did have to have that money together to put it up to acquire the home. But now that you're acquiring $2,000 in rent from your renters, you then have to account for the mortgage that you have on the property. The remaining $150,000 is now as a part of the mortgage you have to pay. The mortgage is going to be about $900 on a $150,000 purchase. Now, the mortgage in principle itself is going to be a little lower than that, but we're estimating at about $900 because you have to account for the insurance on the property and the taxes.
And when you run your numbers for your properties, you're always going to have to account for three things. So put a mortgage calculator on your phone, and that'll give you your principal and interest payments. And then always look up your tax assessment for the area. And then you have to do an insurance estimate to get your numbers for what you'll have to pay every month.
Precisely. And once you do that, we've estimated for our example that you will be at about $900 a month. Once you pay that, in addition to your management company's fees, your management company is going to ordinarily charge you about 10% per month based upon the rent that you're acquiring. And so for our example of collecting $2,000 a month, the mortgage is $900 and your management fees are $200. So you're all in every month at $1,100, but you're collecting $900 per month.
And so the reason why people often choose real estate versus other forms of investing, let's say like the market, is because you can get higher returns over time. So without accounting, and this is going to be a simple return on investment example, without accounting for the tax benefits, you get $900 every month, right? So that's $10,800, and then you divide that times
per year.
Per year, and then you divide that times 50,000, and this is called a cash-on-cash return example. So your return on that is basically 22%. So it's 21.6%. Of course, you're gonna need to set aside about 10% of your overall income from your cash flow for things that go wrong. That's just good business practices. Or set aside $5,000 per property. However you want to set aside your rainy day fund, you do that. And if you have that, you're going to be around at least 15-18%, and you can beat the standard S&P 500 10% that you would account for that increasing every year. So you're able to get really good returns on your money, and this happens in perpetuity until you sell the property.
Yeah, so compared to flipping, right? Let's go all the way back to that flipping example. When we talked about what your profit would have been for the $200,000 purchase, you're looking at $40,000 for that profit for that one time. But with this, the $40,000, you're getting it slower. It's happening over time, but you'll reach $40,000 in profit after about 4 years when you're collecting $900 a month. So, but that's not all, folks. You then move on every year, every month, and you continue to collect this money on this property without having to do too much, because you've acquired the property when it was already renovated. Now, things are, of course, going to go wrong. You're going to have to pour more money into the property, but you have the added benefit of having somebody in that property paying down the mortgage every month. So as you have to pour money into the property to, give it upgrades, fix little things here and there, you are acquiring equity from having a renter pay down the mortgage every month.
Yes, and this is the numbers portion of our buying, hold versus flipping strategy. Now there's a whole nother part of the equation. And a lot of people say, oh, I want to make money. Next, to do what with? So when you get all of this money, and you have stuff coming in, you gotta have a greater goal other than just having money. So in some other episodes, we'll talk about reinvesting your profits into the stock market so you can really double up on your interest and return on investments. Or you're using this money to get into another arena and you can really compound your interests in a business. Or, you just want to set aside money for your children's college fund. But always think about, I want to make money to do what with, and then that to do what with should make you more money.
Greg is always going to tell you about how to make more money and then use that money to make more money, use that money to make more money and make more money.
Yeah.
Whereas, my advice might be, oh, okay, now you got an extra change in your pocket. You should do something fun, maybe? No?
Yeah, do something fun, but
then take the rest and make more money.
Yeah, on the percentages.
All right, well, thanks so much for tuning in. This completes our conversation about the numbers portion of buy and holds and flips. The next episode, we're going to talk about how exactly do you go about flipping a property. We're going to get into the nitty gritty of going through that process, and then we're going to talk about the nitty gritty of doing a buy and hold through what's called the BRRRR method.
Yeah, the BRRRR is really hot.
Yeah, we love the BRRRR method.
The BRRRR method.
All right, thanks so much for tuning in. Talk to you soon.